My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to help you make some money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. But we can bemoan the economy. We can worry about housing. We can fret over mortgage rates. We can debate when and if the Fed will cut interest rates or not. We can rue the day big institutions discovered the yen carry trade. We can gamble on whether our country's headed for a recession. Or we can overlook that whole shooting match and just pick the stocks of tremendous companies and hold them for the ride of a lifetime. Unfortunately, the former set of woes controls the discourse right now. Sometimes that's good, like today, where we got an encouraging jobless claims number this morning, and then the averages roared, with the Dow gaining 683 points, S&P jumping 2.3%,
House of pleasure.
and the Nasdaq surging 2.87%. The usual growth suspects, the Magnificent Seven, particularly Apple and its suppliers, were suddenly able to free themselves from the shackles of gloom and rocket higher. It was the best day for the S&P 500 since 2022, and big cap tech led the session. But have the sellers truly disappeared? For the moment, maybe, but stock prices have become so dependent on the macro data, the carry trade, the Fed chatter, that it's impossible to give you a pat answer, even as I've told you over and over and over again, that corporate America is doing much better than anyone would expect at this point in the cycle. Now, I do know this. Many people correctly now recognize that all stocks live under the tyranny of larger macro forces. Before we decide to buy something, we're supposed to think, we need to, what's going to happen to interest rates today? I mean, if they drop a bit, mortgage rates today, if they fell to a 15-month low, isn't that why the market really went up? Will there be more housing turnover? Will there be more rehab and remodel, especially do it yourself? See, we try to divine if a quarter-point decline in the Fed funds rate will motivate people to buy new cars, maybe boost GM or Ford, or perhaps we just buy an ETF that gives us a piece of economic oomph, some sort of phony industrial amalgam put together to earn fees for the promoter. We mold the notion that there could be a pickup in semiconductors if the economy accelerates, so we buy an ETF that has semis rather than just going after NVIDIA for AI or Texas Instruments for the Internet of Things. That is the world the big institutions deal with. A trading-oriented, short-term guessing game based on the data point of the day, a style that so many now find irresistible. If you're not careful, their thinking becomes your thinking, and you get blinded not by the light, but by a very dim bulb. On Mad Money, I like to approach things very differently. I don't want to be bound by the four walls of the PMIs, the PPIs, the PCEs, the GDPs. We don't want ETFs where we buy the bad along with the good. And we certainly don't want to worry about every tick in interest rates. We don't want to be blinded by that. And you know why? One, because that's a sucker's game. You're letting the macro control your thinking, just like the big boy hedge funds. You're checking your brains at the door. But two is Eli Lilly. This morning, Lilly reported a quarter with $11.3 billion in sales when Wall Street was only looking for less than $10 billion, while raising their full-year sales guidance to $46 billion, full $3 billion above expectations, in large part thanks to these wondrous GLP-1 drugs. Oh, it was a tour de force quarter, one where they highlighted so many different indications for Mounjaro and Zepbound, those are different versions, same stuff, that you have to believe your insurance will cover it. The results are so good that the insurers genuinely may not have a choice, even if they need to pay through the nose for the stuff. Lilly's results had nothing to do with mortgage rates or J. Powell or drug ETF that might have capped your gains if you chose to play it that way. Much better to just go with Eli Lilly, best of breed, which has been the obvious one for quite some time. It's not like nobody saw this coming. If you went with best of breed, you were up 9.5% today. Now, I know this morning I was very concerned that Lilly could miss numbers. I tweeted that around 4 a.m. after the disappointing earnings we got from Lilly's sole competitor, Novo Nordisk, yesterday. I knew that Lilly's drug causes you to lose more weight than their rivals, but I also knew that the expectations had gotten so high that the stock had been acting so terribly that I figured there could be something else afoot. But you know what? I chose to stay the course for the Charitable Trust because of my faith in CEO David Ricks and the company that is Eli Lilly. My faith was rewarded, not only with a blowout of incredible proportions, but also with a series of statements from Ricks that nullified so many claims from Lilly's aspiring competitors, often promoted by charlatans on right here. and how they're working on better GLP-1s. Right now, the rap against Lilly's competition. Lilly's anti-obesity and anti-diabetes drug is a once-a-week self-injection that doesn't hurt. But there are commercials on air that make it look like it hurts like the dickens. Lies. We know that one competitor says it's experimenting with the GLP-1 drug in pill form, not a shot. Well, so is Lilly. We know there's a competitor with the GLP-1 that can inject less frequently. Lilly's working on that, too. We know that there's a competitor with a pill or shot that's targeting only fat and not all body mass. Well, you know who else is working on that? Eli Lilly. But what many learned today is that Lilly's ahead of everyone in this business. And in this business, let me tell you what happens. The tie goes to the incumbent. The FDA isn't going to bless lots of products from competitors faster just because it's worried about antitrust. They don't care about antitrust. That's a different branch of government. And Wall Street isn't schooled in the process of drug trials and drug approvals. These people pushing these rivals don't understand that a company that doesn't have much of a reputation with the FDA will have a harder time getting something approved. And some of these smaller operators can't afford that delay. After the Lilly call, I realized that there are so many trials going on for so many indications that even up this much, the stock might not be for sale. It may still be able to go much higher, especially when Rick's talked about how only Lilly has the manufacturing scale to make enough GLP-1 drugs to meet the demand. Lilly is committed to building more than $20 billion worth of facilities or upgrading them in the U.S. and Europe. No one else can afford to spend like that. So you have a company with a revolutionary drug that has multiple indications, a drug where they have both the lead in all formulations and the scale to stay as the top dog. We just have to hope that the Justice Department allows them to benefit from the billions they poured into the franchise rather than penalizing them for being so far ahead of the competition. I think they're less likely to be targeted than the big techs this administration loves to go after, because without patent protection, no drug company would ever develop anything new. Look, today was a very good day for everything. It's a day we'll look back on maybe 24 hours from now and perhaps say, hey, you know what? We're done with the detritus of the yen carry trade. Maybe it's the day where we restore the dethroned Mag 7. Whatever you want to say. Maybe even the bedraggled NVIDIA can come back to life. But the bottom line, I just come back and say that if you pay attention to the real world, you may find yourself taking a GLP-1 and want to buy the stock of Eli Lilly. But if you pay too much attention to the financial world, you might have convinced yourself that this stock wasn't worth owning thanks to the fallout from the yen carry trade and the collapse of the state of the economy. The all-holy macro would led you astray and kept you out of this terrific gain. That's why I like to find the best companies for you with the best stories for you and just stick with them through thick and thin. Let's take calls. Let's go to Kior in New Jersey. Kior.
Hey, Cramer, how are you?
I am doing well. How about you, Kior?
Pretty good. A quick question. I hope, first of all, my son is watching this, a teenage son. I always encourage him to invest in early age. But here's my question.
Okay.
Deckers Outdoor, DECK. What's your thought on this one, especially for long term, say 5 years?
Well, I have to tell you that these stocks are fashion. And fashion goes in and out. That said, I think Deckers has at least another year in it, but I can't say 5, 6 years because it is fashion, and fashion is not sustainable. How about Richard in California? Richard!
Hey, Jim, how are you?
I am good. How about you, Richard?
Good. I talked to you maybe a few times in the past year and a half, and I just had a call in and Paul revere the stock one more time. I just got off the earnings call of this company. It's amazing. Enormous growth in all their metrics. Their core business is growing fast from insurance companies sending patients out of expensive hospital settings to outpatient centers. Company developed AI in detecting cancer is an absolute game changer. The United Kingdom has their AI in use for population health, and the soon will enter the U.S. It's hard to imagine what this will do to the growth of the smaller company. Their AI will be licensed and sold endless healthcare companies in the U.S. In 35 years of investing, I've never seen such a great investment as RadNet.
High endorsement. What is the stock?
RadNet.
I didn't hear the stock. RadNet. Okay, RadNet is a very good company. We've had them on. I think the world of them. I bought for my charitable trust. I bought GE Healthcare Technology, which is not nearly as good as RadNet. It just happens to be cheaper. I agree with you that it's quite a good story. Let's go to Bob in Florida, please. Bob.
Jim, this is Bob from Florida.
Hey, no.
I'm a founding member of the club.
Oh, excellent. Thank you. Thank you very much. Big meeting next week. Don't forget. Monthly meeting.
I will.
Okay.
I own shares of Schwab, and I've been losing money on them. Should I keep them, or should I use the money elsewhere?
Which stock? I'm sorry? Schwab. Okay, I happen to like Schwab very much. They came on the show, Mr. Bettinger told a very good story. I know that there's short-term considerations. I think they will go away. I think it's a good level. I would buy the stock of Schwab. I buy half a position here and then half a position when some knucklehead analyst downgrades it again, because that's what they tend to do. Look, I like to find good stocks and good companies with good stories. That's how you avoid being swayed by the financial chatter and make smart investments instead of going in and out like some sort of hedge fund joker. On Mad Money tonight, Dutch Bros stock is sinking if the company gave a half, let's say, call it a cup half empty outlook for its store count. But what else was in the quarter that investors may have missed? I've got an exclusive with the CEO. Then we're hearing the consumers feeling some tightness. But then why are the food delivery apps still putting up solid numbers? Aren't they expensive? I'm taking a closer look at the sector, taxes and fees included. And as people return to non-urgent medical care after the pandemic, I'm taking a look at one medical device player benefiting from the uptick in procedures. So do not miss my exclusive with Zimmer Biomet, and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.